I'm John Olden, and this is my finance project. The first industry we'll look at is internet advertising portals. That includes Yahoo, Google, Millennial Media, Meet Me, and Remark Media Incorporated. First up is Yahoo. Yahoo has grown its liquidity ratios, and it shows us that a large portion of their assets is funded by equity. As well, they have a cash coverage ratio of 84.27, meaning they can cover their interest expense. Asset turnover for Yahoo is well below 1. This may be seen as asset inefficiency, but it should be noted they have a very large asset base comprised of very expensive technology. Through 2007 through 2013, Yahoo averaged 24.76% profit margin, 5.85% return on assets, and 10.47% return on equity. For 2013, the ROE is being driven by tax and interest burden, something they don't have control over. Yahoo, though having dropped from 49 in PE in 2007 to 19 in 2011, has risen up to 29.17 in 2013. One concern for Yahoo, looking at its revenue it receives, is that it receives 36% of its revenue from Microsoft alone. So if Microsoft were to get into a bind, you could also see that reflect on Yahoo as well. Next up is Google. Google has let their liquidity fall, but they are still able to take care of any current liabilities. Their cash is a large portion of their current assets, and a large portion of their assets are funded by equity. Cash coverage of 215 means they can cover their interest expense and afford more debt if they need to. Asset turnover for Google is well below 1, but like Yahoo, this may be seen as asset inefficiency, but it should be noted they have a large asset base comprised of technology that is very expensive. Through 2007 through 2013, Google averaged 24.28% profit margin, 15.68% return on assets, and 18.59% return on equity. Through 2007 through 2013, their ROE slightly dips. That's due to a little drop in operating margin and lower asset turnover. Their PE of Google dropped in 2007 from 52 to 21 in 2012, but it did rise currently for 2013. Currently, the current PE ratio of 31.63. Millennial Media. Their liquidity ratios range from 1 to 2, with cash and receivables making up the largest portion of their current assets. Their assets are largely funded by equity. Their leverage dropped from around 3 to 1.2, and probably for the best, as their cash coverage is negative, meaning they cannot afford the interest involved with borrowing that money from the creditors. On the other hand, their total asset turnover is 1.48, average from 2007 to 2013. This is good for them because it shows that it is being more efficient with its assets compared to others in the same industry. Their ROE is being driven down in 2013 by a negative operating margin. And as a result of losses, they have no current price to earnings ratio. It might be better off for them to liquidate their assets and get out now before they incur more losses. Meet Me Incorporated. Their liquidity ratios range from 0.6 to 1.66, showing a large portion of its current assets is their receivables. Their leverage drops, and is probably for the best, as their cash coverage is negative, meaning they cannot afford the interest involved with borrowing money from creditors. Their total asset turnover is 0.23 from 2007 through 2012, but it did grow to 0.403 in 2013. For 2013's ROE, it is being driven down by negative operating margins, and as a result, they have no price to earnings ratio, and they might be better off liquidating their assets and get out now before they incur more losses. Remark Media. Their liquidity ratios have declined from the 18 to 20 range to the now 0.45 to 0.61 range, with cash making up a large portion of its current assets. It's growing its leverage from 1.08 to 2.96, meaning assets are largely funded by debt. But but its cash coverage shows that it cannot afford it, and their total asset turnover is well below 1. And they had an abysmal ROE being driven down by operating margin of negative 287.37 in 2013. And as a result of the losses, they have no price to earnings ratio. And like the past two companies, they might be better off liquidating their assets and get out now before they incur more losses. Here we have the weighted average cost of capital and economic value added for the 5 internet portal companies. We'll start off with Yahoo in the top left. Their weighted average cost of capital is 9.2%. And if we look at their economic value added, it goes up, then it goes down, then it goes up, then down to where it's currently at negative 907 million. If we go over to Google, on the other hand, they have a little bit higher weighted average cost of capital of 10.2%. And if we look at their economic value added, we can see it goes up, to where it was before it drops, around where it's currently at. But even when it dropped to just around 1 billion economic value added. It went back up to its peak to almost 5 billion, to where it's currently at now at 3.4 billion. That's pretty good. Looking at Millennial Media, if we look at their weighted average cost of capital, it's even higher than Google's at 11.7%. If we look at their economic value added, we see it's on a steady decline down. Looks like it even started off below zero, where it's currently at is negative 62 million. Here we have Meet Me, and they have the highest weighted average cost of capital at 12.5%. If we look at their economic value added, we see that it starts off below zero as well. It goes down, then it comes back up, then it goes down, well past 20, and it comes back up to where it's currently at of negative 15 million for economic value added. And lastly, we have Remark Media, with the lowest weighted average cost of capital of 6.4%. If we look at their economic value added, we see that it starts off below zero, and also that even at its peak, it was probably almost breaking even, almost there. That actually might be negative 5, but where it settles is negative 14 million. If I had to pick a favorite company of these 5 in this industry, it would definitely be Google. They have a probably above average cost of weighted capital, but their economic value added is sitting at $3.4 billion, and that's very impressive. The next industry we'll look at is gaming companies, and that includes Boyd Gaming, Isla Capri Casinos, MGM Resorts International, Penn National Gaming, and Pinnacle Entertainment. Boyd Gaming Corporation. Boyd has let its liquidity ratios drop. It shows us that about half of their current assets are cash, with the next largest portion being inventory with very little in receivables. Their assets are mostly funded with debt over equity and are shifting even more towards debt funding. Boyd's cash coverage is declining from 3.42 in 2007 to 1.663 in 2013, but they are still able to cover their interest expenses. Boyd has a total asset turnover of 0.411 from 2007 to 2012, with 0.48 in 2013. From 2007 to 2013, Boyd averages negative 5.15 profit margin, negative 1.95 return on assets, and negative 19.25 return on equity. Though the ROE improved from 2012 to 2013, but it was still negative. What helped it increase was an increase in operating margin. From 2007 to 2011, their PE ratio averaged 37.915. But currently, as a result of losses, they have no price to earnings ratio. Isla Capri Casinos. Isla has let its liquidity ratios drop as well. Cash is the largest portion of their current assets, and their assets are mostly funded with debt over equity, and they are even shifting more of their funding towards debt funding. Isle has grown its cash coverage, but had a small decline, but still able to afford its debt. Their asset turnover of 0.56 average from 2007 2012, with a 0.59 average in 2013. From 2007 to 2013, Isle averages a negative 3.36 profit margin, negative 1.92 return on assets, and negative 14.79 return on equity. And their ROE is being driven by interest burden in 2013. Their current PE ratio is 55.15, meaning that investors expect growth from Isle stock. MGM. MGM has grown its liquidity ratios, but they have slightly declined. Cash is the largest portion of their current assets. Their assets are mostly funding with debt over equity, and they're shifting more towards debt funding. Their cash coverage has declined from 2.3 in 2007 to 0.94 in 2012, but has since risen to 2.22 in 2013 to where they can now afford their debt. Their asset turnover is 0.31, averaged from 2007 to 2012. And for 2013, they're sitting at 0.375. From 2007 to 2013, MGM averages negative 2.54 profit margin, negative 0.43 return on assets, and negative 4.09 return on equity. Though the ROE improves from 2012 to 2013, it is due to better interest burden and improved operating margin. Their current PE ratio is an astounding 259.94, which shows that investors have huge expectations for MGM stock. Penn National Gaming. Penn has let its liquidity ratios grow. Their assets are mostly funded with equity over debt, and they are shifting even more towards equity funding. Penn also goes from a 4.64 leverage in 2007 to a 2.60 in 2013. Penn has also grown its cash coverage from 3.03 in 2007 to 6.87 in 2013, showing that it can cover its interest expense and can afford more debt. Their asset turnover averages 0.529 from 2007 to 2012 and has grown slightly to 0.75 in 2013. From 2007 to 2013, Penn averages a negative 3.48 profit margin, negative 2.44 return on assets, and a negative 6.43 return on equity. In 2013, their ROE was driven down by negative interest burden. The average PE ratio for Penn was 22.12 from 2007 to 2012, but due to a loss in 2013, they do not have a current PE ratio. Pinnacle. Overall, Pinnacle has grown its liquidity ratios from 2007 to 2013. Inventory is the largest portion of its current assets, followed by cash. Pinnacle is funding most of their assets with debt over equity and are shifting more towards debt funding. For cash coverage, Pinnacle averaged 1.646 from 2007 through 2011, but recently it has not been able to afford its debt. Their asset turnover averaged 0.527 from 2007 to 2012, but it dropped to 0.409 in 2013. From 2007 to 2013, Pinnacle averages negative 11.42 profit margin, negative 5.64 return on assets, and negative 23.89 return on equity. And the ROE in 2013 was driven down by an increase in leverage, negative interest burden, and a drop in operating margin. Its current PE ratio is 39.84, so investors are expecting some growth from Pinnacle. Here we have the 5 companies' weighted average cost of capital and their economic value added. Starting with Boyd in the top left, we can see that they are 100% cost of capital is from equity, and that's at 9.6%. If we look at their economic value added, we can see here it's just above 0. Then it takes a downturn, then it just stops right there, and then it comes back up to where it's currently at 53 million. We come over here and look at Ala Capri. We see that a majority of its funding, of its cost of capital, comes from debt over equity. And its weighted average cost of capital is 6.2. So it being majorly funded by debt shows that it has a lower average cost of capital because debt is cheaper than equity. Looking at their EVA, we see that it's kind of rocky. starting out below zero here. It doesn't get above zero really well until 2014, this year, where it's currently at a 48 million economic value added. Looking at MGM, it's a pretty close split between equity and debt. So it's going to have probably a little bit higher than average weighted average cost of capital of 8.9%. Looking at their economic value added, it's rocky as well. Below zero, above, below, well below, until it finally comes back up to a very good economic value added, actually, of close to 500 million. Next, we have Penn National Gaming. It's got a little bit more weighted average cost of capital. It's it's the cheapest here, of 4.5%, with most of it by debt, the other by equity. Looking at their economic value added, started off below zero, goes up, had some very good economic value here, then it came down, back up, then it came crashing down again at negative 663 million. Last, we have Pinnacle Entertainment. Looking at their weighted average cost of capital at 5.3. This is due thanks in part to majority of it being funded by debt, which is cheaper than equity. Looking at their EVA over time, see that it started off at zero, has been below zero for a good while, till recently here. Then it just drops down, goes back up and drops down again to where it's currently at a negative 406 million. If I had to pick a favorite company in the gaming industry, it would be MGM. They have an weighted average cost of capital of 8.7%. Yes, it is above the others, but it's not the highest. But it does have the best economic value added of 524.5 million. Their PE ratio has them set for a tremendous growth at 259, and they have a good mix of debt to equity when it comes to their cost of capital as well. The last industry is the video game software industry. The companies are Electronic Arts, Take-Two, Majesco, Activision, and Glue Mobile. Electronic Arts, who I'll refer to from now on as EA. EA has let its liquidity ratios drop from 2007 to 2013. The largest portion of its current assets is cash. They are mostly funded in equity, by equity in 2007 through 2011, but has since shifted to being primarily funded by debt. EA's cash coverage was not available from 2007 to 2011, but averaged 12.95 from 2012 to 2013, meaning they can afford their debt and won't have any trouble getting new debt if they need it. Asset turnover from 2007 to 2012 was averaged at 0.736, and it rests at 0.719 in 2013. From 2007 to 2013, EA averages negative 8.23 profit margin, negative 6.25 return on assets, and negative 9.18 return on equity. In 2013, their ROE was driven by an increased operating margin and interest burden greater than 1. Their current PE ratio is 240.46, meaning investors expect a lot of growth out of EA stock. Take-Two. Take-Two liquidity ratios appear to be growing from 2007 to 2013. They are shifting from a relatively low cash ratio to a much higher cash ratio in that time as well. Their assets were mostly funded by equity in 2007 to 2012, but has since shifted to being primarily funded by debt. Their cash coverage went from 84.96 in 2008 to 8.09 in 2013, which has drastically fallen, but they are still able to afford their debt. Their asset turnover from 2007 to 2012 was averaged at 1.12, but it currently has dropped to 1.001 in 2013. Take-Two averages a negative 4.24 profit margin, negative 3.29 return on assets, and negative 5.98 return on equity. The ROE increased from 2012 to 2013. This was driven by an increase in operating margin and increase in asset turnover, and their current PE ratio is at 9.86. Majesco. Majesco's liquidity ratios rose from 2007 to 2012, but has lately fallen in 2013, Inventory makes up a majority of its current assets, and their assets are mostly funded by debt from 2007 to 2011, but has since shifted to being primarily funded by equity. Their cash coverage rose and fell from 2007 to 2012, but in 2013, it's negative 25.44, meaning they cannot afford their current debt. This would explain a shift away from debt funding to equity funding. Their asset turnover was 3.05 from 2007 to 2012, which is really positive compared to others in the industry, but has fallen to 1.087 in 2013. Majesco averages from 2007 to 2013 a negative 4.4 profit margin, negative 6.85 return on assets, and negative 32.88 return on equity. The ROE dropped from 2012 to 2013, driven by a negative operating margin. And for the years that Majesco had a PE ratio, it averaged 9.38, but currently it does not have a PE ratio. Activision. Activision has let its liquidity ratios decline from 2007 to 2013, but cash comprises the largest portion of its current assets. Their assets are primarily funded by equity, but there is a gentle shift towards debt funding. Activision has an impressive cash coverage ratio from 2007 to 2012, averaging 859. But there was not information on cash coverage for 2013. Their total asset turnover was 0.442 from 2007 to 2012, but it has slightly dipped to 0.325 in 2013. Activision averages from 2007 to 2013 an 11.81 profit margin, 4.5 return on assets, and 5.93 return on equity. Their ROE increased from 2012 to 2013, driven by an increase in financial leverage. And their current PE ratio is 23.77. Glue Mobile. Overall, Glue has let their liquidity ratios fall from 2007 to 2013, but cash comprises the largest portion of its current assets. From 2007 to 2012, Glue has shifted from primarily debt funding to being funded by equity. Glue has a history of negative cash coverage, so they are not able to afford their debt. This would explain the shift away from debt funding to equity. Their total asset turnover is 0.99 average from 2007 to 2012, but has risen to 1.304 in 2013. And they averaged negative 33.89 profit margin, negative 31.56 return on assets, and negative 82.64 return on equity. In 2013, their negative ROE is driven by negative operating margin. And due to consistent losses, they do not have a PE ratio. It can be said they would be better off liquidating before they lose more. One concern for Glue Mobile is that 50% of its revenue comes from Apple and 23% of its revenue comes from Google. So having close to 3/4 of its revenue come from two companies that are very almost similar to each other, that if the industry was to get hit, that they would also get hit as well, tremendously. Here we have the weighted average cost of capital and the economic value added for the video game software companies. First up is Electronic Arts. As we can see, their weighted average cost of capital is 9.33, and a good bit of that is equity, 94% of it exactly, with 6% at debt. So since equity is more expensive than debt, they're going to have a higher weighted average cost of capital. If we look at their economic value added, started off positive, went down negative. This is around the time of the economic collapse, downturn. Then has come back up. Hasn't really broke zero yet, but it's currently at negative 261 million. Next is Take Two, with a weighted average cost of capital of 8, which is primarily funded by equity, so it will be higher as equity is cost more than debt. If we look at their economic value added, for a good bit it's 0 or well below 0, not until recently around 2013. The end of 2013 into 2014 does it make positive 310 million economic value added. Here in the middle we have Majesco. Its weighted average cost of capital is 10.4%, and it is fully funded by equity, so it will be as high as it can be. For its economic value added, you can see it started above 0, went up, then went down, kind of was at 0, then back down, then up, then it has come back down to where it's currently at a negative 16.85 million. Next, we have Activision, with its weighted average cost of capital of 8.3%. Yes, most of it is funded by by equity, so it will be higher than debt. Its economic value added, it starts off below 0. Really, it's been below 0 a lot. It still is. It ends up at negative 91 million economic value added. And lastly, we have Glue Mobile, with the highest weighted average cost of capital of 13.7%, and it is exclusively all funded by equity. Looking at its economic value added, we see negative. It's all actually below 0 here. So, and it actually ends up at negative 21.55 million economic value added. If I had to pick a favorite video game software company, it would have to be Activision. Though they have a negative EVA, they have consistent returns on assets and equity compared to others, and they are moving towards more debt funding over equity, so that would bring down their weighted average cost of capital, so we could see positive economic value added in the near future for them. Considering the three companies that I picked relative to their industries, which was MGM for gaming, Google for internet advertising, and Activision for video game software, my favorite overall would have to be Google. They are earning more than others in the industry, more than others actually in pretty much almost every other industry, and they have consistent returns for investors, creditors, and shareholders.